Welcome back to Skytech-Lens. Once hailed as the crown jewel of Elon Musk's global empire, Tesla's Shanghai Gigafactory stood as a symbol of innovation and ambition. It was the beating heart of Tesla's international operations, a testament to the company's ability to break into the world's largest and most competitive car market. For years, this sprawling facility powered Tesla's meteoric rise in China, churning out vehicles at a pace that left competitors scrambling to keep up. The factory's relentless output fueled dreams of electric dominance not just in China, but across Asia and beyond. But by the middle of 2025, the atmosphere has changed dramatically. The optimism that once filled the air has been replaced by a sense of unease and uncertainty. On the production lines, the familiar hum of machinery is now tinged with anxiety. Workers move with a sense of urgency, aware that Tesla is facing a storm that threatens its hard-won dominance in the region. Deliveries have plunged to an 18-month low, leaving vast parking lots filled with unsold vehicles. Inventory turnover has slowed dramatically, with over 40,000 more cars sitting idle compared to the same time last year. Tesla's once impressive market share in China has slipped from 16.5% to just 13% in a matter of 7 months. Showrooms that were once bustling with eager customers now stand noticeably quieter. The reasons behind this downturn are complex, but at the center is what analysts are calling a triple squeeze. Tesla is being battered by a brutal price war, surging costs, and mounting geopolitical barriers that threaten to upend its business model. Local Chinese rivals, emboldened by government support and aggressive strategies, are slashing prices to win over cost-conscious consumers. The competition is fiercer than ever, with new models and deep discounts flooding the market. At the same time, the cost of raw materials like lithium and copper has soared, squeezing Tesla's margins. Energy prices remain volatile, adding another layer of financial pressure. And as if that weren't enough, new tariffs and export restrictions have made it increasingly difficult for Tesla to ship cars abroad, threatening its global supply chain and future growth. Tesla's ambitious goal of producing 900,000 vehicles in 2025 now seems out of reach. Current projections suggest the company may only hit 820,000, a significant shortfall that could have ripple effects throughout the industry. Missing this target could force Tesla to revise its global delivery guidance downward, sending shockwaves through the stock market and rattling already nervous investors. The question now looms large: can Elon Musk, known for his bold vision and risk-taking, steer Tesla through this perfect storm and reclaim the company's momentum in China? The world is watching, and the stakes have never been higher. China's EV market has become a fierce battleground, where automakers are locked in a relentless struggle for dominance. The competition is unlike anything the industry has seen before, with dozens of brands vying for the attention of millions of consumers. In this high-stakes environment, every company is fighting to outdo the others, and the pressure is intense. Price has become the weapon of choice, wielded ruthlessly by both established giants and ambitious newcomers. Discounts, incentives, and special offers are everywhere, turning showrooms and online listings into virtual battlegrounds. Even Tesla, once seen as an untouchable premium brand, has been forced to join the fray. In April 2025, Tesla slashed prices by up to 5%, hoping to reignite demand and defend its market share against a wave of aggressive competitors. But the gamble didn't pay off as expected. While sales volume ticked up only slightly, the real cost was felt in Tesla's shrinking profit margins. The company found itself caught in a dangerous squeeze, sacrificing profitability for the sake of staying relevant. The main aggressor in this price war is BYD, a homegrown powerhouse that has taken the fight to a whole new level. BYD slashed prices on 22 models, with some discounts reaching as high as 30%, an unprecedented move in the industry. Their most striking offer, the Seagull EV, now available for just $7,750. This ultra-affordable price tag has sent shockwaves through the market, making electric cars accessible to a much wider audience. For Tesla, matching these prices would mean incurring massive losses, something the company simply can't afford if it wants to survive in the long run. BYD's strategy is clear: flood the market with affordable options, overwhelm the competition, and squeeze out rivals who can't keep up with the pace or the price cuts. Each new round of price cuts forces Tesla into a painful dilemma. Should it sacrifice profits to maintain market share or risk losing ground to competitors by holding the line? The result is a vicious cycle, with shrinking margins and mounting pressure on all sides. The industry is caught in a downward spiral, and there's no easy way out. For Tesla, the days of easy profits in China are over. The company now faces a harsh new reality, where every decision carries enormous risk. In this brutal price war, survival depends on endurance, on which company can withstand the financial pain the longest, and who will be left standing when the dust finally settles. Tesla's struggle is inseparable from BYD's meteoric rise. BYD's edge comes from vertical integration, especially its in-house battery tech. Its blade battery and cell-to-pack design cut weight and costs, giving BYD a structural advantage. While Tesla struggles to scale its own battery tech, BYD has already rolled out its innovations across its lineup. In Q1 2025, BYD posted a 20% gross margin and over €1 billion in net income, outpacing Tesla's 16% margin and $409 million profit. BYD is now targeting 5.5 million vehicle sales this year and expanding aggressively overseas. In April, BYD outsold Tesla in Europe for the first time. The local dragon is now a global challenger, casting a long shadow over Tesla's future. As Tesla fights price wars, rising costs deliver a second blow. Lithium prices rebounded sharply in early 2025, driving up battery costs for Tesla's affordable models. Nickel, manganese, and cobalt prices are also climbing, squeezing margins on long-range vehicles. New Chinese electricity tariffs have added about 100 yuan per car, millions in extra costs annually. Environmental regulations, especially for exports to Europe, force Tesla to invest in costly upgrades. The EU's carbon border adjustment mechanism means Tesla must retrofit its Shanghai plant to meet stricter emission standards. These unplanned expenses further erode profitability. Every new regulation or cost increase tightens the financial vice. The second squeeze is relentless and unforgiving. The third squeeze is geopolitical. US-China trade tensions mean Tesla can't export US-made cars to China, or Chinese-made cars to the US profitably. The EU has slapped tariffs of up to 45% on Chinese EVs, including those from Tesla's Shanghai plant. Even within China, new regulations threaten to disrupt the market, as Beijing eyes a crackdown on destructive price wars. These shifting policies create uncertainty and risk for Tesla's operations. The Shanghai export hub model is under threat. Geopolitics now shapes every move Tesla makes in China. Tesla isn't standing still, it's fighting back. In the face of mounting challenges, the company is determined to adapt and survive, refusing to let setbacks define its future. Every decision now is a calculated move in a high-stakes game, as Tesla works to secure its place in a rapidly changing industry. The company is accelerating its shift to cheaper lithium iron phosphate batteries to buffer against raw material volatility. This strategic pivot isn't just about cost, it's about building resilience. By relying less on expensive and scarce materials like nickel and cobalt, Tesla hopes to stabilize its supply chain and keep its vehicles affordable for more customers. Engineers are hunting for savings in every component, using lightweight alloys and recycled materials. They're rethinking manufacturing from the ground up, scrutinizing every bolt and bracket for potential efficiencies. The goal? To squeeze out waste, lower costs, and make each car more competitive in a crowded market. To hedge against a weakening yuan, Tesla is invoicing some suppliers in local currency. This financial maneuver helps shield the company from currency swings that could erode profits, and signals a deeper commitment to its Chinese supply chain partners. Hopes for high-margin software revenue in China have fizzled, as full self-driving subscriptions see little uptake. Despite heavy investment in autonomous technology, Chinese consumers remain cautious, and regulatory hurdles persist, making it difficult for Tesla to unlock the profits it once envisioned. With domestic sales faltering and European exports squeezed by tariffs, Tesla is rerouting Shanghai production to Australia, Korea, and the Middle East. These new destinations offer hope, but also come with their own logistical and regulatory challenges. These markets help, but can't fully offset the slowdown in China and Europe. The demand is real, but it's not enough to fill the gap left by Tesla's two largest markets, forcing the company to search for new opportunities wherever it can. The moves are necessary but feel defensive. Tesla's leadership is under pressure, forced to make tough choices to protect the company's future, even if it means retreating from earlier ambitions. Tesla is buying time, not winning ground. Each adjustment is a temporary fix, a way to keep the company afloat while it searches for a more permanent solution. The search for solid footing continues. For Tesla, the path ahead is uncertain, but the drive to endure and innovate remains as strong as ever. Tesla's vulnerability in China is also about product fit. Its lineup, mainly the Model 3 and Model Y, is aging and misses the mark for many Chinese buyers. Demand is booming for smaller, cheaper sedans and crossovers, segments where Tesla has no offering. BYD and others are filling this gap with stylish, affordable models. Tesla's answer, a rumored entry-level Model 2, won't arrive until at least 2026, and not in Shanghai. This leaves Tesla exposed to further market share erosion. In China's fast-moving market, a lean lineup is now a liability. Without fresh products, Tesla risks being left behind. Wall Street is watching and worrying. Tesla's profit margins have dropped sharply in 2025, with no quick recovery in sight. The triple squeeze, price cuts, rising costs, and currency headwinds has replaced optimism with caution. Tesla's energy storage business is growing, but it can't offset the automotive division's struggles. Investors are demanding a credible plan to restore profitability and refresh the product lineup. The China story, once Tesla's growth engine, is now its biggest question mark. The company's future depends on how it responds to these challenges. The world is waiting for Musk's next move. Tesla's China story has reached a crossroads. The triple squeeze has ended the era of easy growth and fat margins. To survive, Tesla must refresh its product lineup, fast, and localize affordable models for China. Manufacturing innovation is critical to close the cost gap with BYD. The company may need to accept a smaller but profitable market share and pivot Shanghai's output to other regions. China remains Tesla's most important market and a global benchmark. Failure here would force a rethink of Tesla's entire strategy. The coming months will test Tesla's resilience and ability to adapt. The storm over Shanghai could reshape the global EV landscape. Thanks for watching a video and subscribe the channel now for more updates. Thanks.